Welcome to the Deep Dive. We're the show that tries to cut through all that noise and, well, get straight to what really matters.
And there's a lot of noise out there, especially with finance.
Oh, definitely. I mean, if you're like most people listening, you've probably felt it, right? That kind of constant anxiety around financial news.
Yeah, markets crash, trends pop up and disappear just as fast.
hmm
It feels like chaos sometimes.
Exactly. So the big question is, how do you find any sense of stability, confidence even, when it comes to your money in the middle of all that?
It's a tough one.
Well, today we're doing a deep dive into an investment philosophy that's really designed to, well, outlast that chaos. We're calling it buy, hold, chill.
I like that. Chill is the key part.
It really is. And look, this isn't about just sticking your head in the sand and ignoring the market. It's more about mastering a mindset.
A mindset that empowers you, helps you navigate the inevitable ups and downs without losing sleep.
Precisely. And to guide us, we're drawing on some heavy hitters. Two of the most influential investment thinkers ever, really.
We're talking Benjamin Graham.
Right, the father of value investing, author of The Intelligent Investor. A classic.
And John C. Bogle, the founder of Vanguard, the champion of low-cost index funds. You probably know his book, Common Sense on Mutual Funds.
Two legends. So, our mission today, we want to pull out the most important nuggets from their wisdom. Stuff that's truly essential.
Hopefully give you a few aha moments along the way.
Yeah, and leave you feeling informed, confident about long-term investing, but crucially, not overwhelmed.
Sounds like a plan. Let's dig in.
Okay, so let's start with Graham. It's amazing how relevant his ideas still feel, even though he was writing decades ago.
It really is. He kind of laid the philosophical groundwork for this whole chill approach long before computers dominated trading. He urged people to look past the daily noise.
And focus on what? The fundamentals.
Exactly, fundamental value. Which leads to his core principle, and it sounds so simple, but it's profound.
Which is?
A stock is a piece of a business. It's not just a ticker symbol flashing on a screen.
Right. We see the blips, the red and green, the hype cycles, but it represents actual ownership in a company. Why is that so hard to remember sometimes?
Well, the market itself almost encourages you not to remember. It's all about the price action, the short term. If you just see a ticker, you're thinking like a speculator, not an owner.
Like chasing those fads Graham warned about. Stuff like the January effect.
Yeah, exactly that kind of thing. Remember that. The idea that small stocks just automatically did great every January.
Totally. Didn't last, did it?
Of course not. Graham knew that if there was some easy formula, everyone would do it and the opportunity would just vanish. Poof.
So the real power is in understanding the business itself, its earnings, its debts, its position in the market.
Precisely. The share price is almost secondary in his view. It's a mindset shift. That's where buy, hold, chill really starts.
And he had that great story to illustrate how we should think about those daily price swings. Mr. Market.
Ah, yes. Brilliant allegory. So imagine you co-own a business with this partner, Mr. Market. Every single day, this guy shows up. Every day. And he offers to either buy your share or sell you his share.
Sounds convenient, maybe?
Well, here's the catch. Mr. Market is, let's just say he's emotionally volatile, a complete wreck.
Uh-oh.
Some days he's bouncing off the walls, totally optimistic, offers you a ridiculously high price. Other days he's sunk in gloom, terrified, and offers to sell you his share for peanuts.
So the smart investor doesn't get caught up in his drama.
Exactly. The intelligent investor, Graham's term, is a realist. They use Mr. Market. They sell to him when he's euphoric and buy from him when he's depressed.
Instead of letting his mood swing their mood.
Right. Don't panic when he's down. Don't get greedy when he's up. Treat him like a tool, not a guide.
Which leads right into how Graham viewed market fluctuations overall. Not as scary things, but opportunities.
Opportunities or just noise to be ignored. He literally said, if you own sound stocks, you should expect their prices to fluctuate. Don't get concerned by sizable declines, nor become excited by sizable advances.
That is the chill part right there.
Yeah.
It's expected.
It is. He said market prices are there for your convenience, either to be taken advantage of or to be ignored. Simple as that.
And he had that rule right. Never buy right after a big jump or sell right after a big drop.
Yes, a straightforward rule based on avoiding emotional reactions. Because, fundamentally trying to predict the market, Graham thought that was a fool's errand.
Why? Too many unknowns.
Completely. Inflation, interest rates, recessions, wars. The future is almost entirely uncertain, he said. So don't invest based on shaky predictions.
Invest based on what then?
Protection. Protection from paying too much, protection from being overconfident. You build resilience into your strategy.
Which is where the margin of safety comes in, his cornerstone idea.
Absolutely paramount. You look for stocks, businesses really, trading at a hefty discount to what they're actually worth, their intrinsic value.
So you have a buffer.
Exactly, a cushion. If things go unexpectedly wrong, or even if your own analysis wasn't perfect, that discount protects you. It absorbs some of the chaos, like building a bridge way stronger than it technically needs to be.
That makes sense. Okay, so Graham sets this incredibly solid foundation. Treat stocks like businesses. Use Mr. Market. Don't be used by him. Expect volatility. Demand a margin of safety. That's the philosophy.
The bedrock, yeah.
But then, how do you translate that for, the average person in today's world? That feels like where John Bogle comes in.
Decades later, yeah. And his impact was just massive. You mentioned the accolades, Fortune's investment giant, times 100 most powerful people.
Warren Buffett was a huge admirer too, wasn't he? Praised Bogle's honesty, his focus on the everyday investor.
He did. Buffett really highlighted Bogle's passion for everyday Americans. You feel that when you read Bogle, he was genuinely trying to help regular people succeed.
And his big insight, much like Graham's, was about simplicity, right? He said the secret is there's no secret.
Yeah, exactly. The secret of investing is finally that there is no secret. In a world selling complexity, he championed radical simplicity.
So what was his simple plan?
Follow a simple plan and let the cycles of the market take their course. Just let it ride. That's the buy, hold, chill instruction manual, pretty much.
And central to that is using time to your advantage.
Hugely important. Time is your friend, he said. Give yourself all the time you can. Begin to invest in your 20s, even if it's only a small amount, and never stop.
It's all about that compounding magic.
The miracle of compounding, he called it. And the numbers are just staggering. He showed how, $10,000 invested in stocks could grow to nearly $1 million over decades.
Compared to putting it in savings, where it would be, much less.
Way less. Like $70,000. He called the difference awesome. But, and this is key, you only get that miracle if you avoid the other side of the coin.
Which is?
Impulse. Impulse is your enemy, he was adamant. Eliminate emotion from your investment program. Have rational expectations.
So accept the volatility. The cold, dark winters, as he put it.
Yeah, knowing they'll eventually await a bright, bountiful springs, that's the chill mindset in practice. Trusting the long-term rhythm.
But is that rhythm really reliable? I mean, markets feel wilder now. That standard deviation thing you mentioned earlier, 20.4%, sounds jumpy.
It is jumpier in the short term. Volatility has increased. But here's the fascinating thing Bogle pointed out. The market's real rate of return after inflation has been remarkably steady over long periods.
Really? Even with all the drama?
Yep. He showed that from, say, 1982 to 2009, the real return was about 6.8% a year. That pretty much matched much earlier historical periods. So the noise got louder, but the underlying signal of long-term growth stayed consistent.
Okay, that does give you confidence to just hold on.
Right. But there's a catch. Even if you get those great long-term returns, something can silently eat them away.
Costs and taxes. Bogle's tyranny.
The tyranny of compounding costs, yes. It's insidious. Even tiny-sounding percentages, a percentage point or so, he said, have a staggering impact over decades.
How does that work? Give us an example.
Okay, think about fund expenses. A super low-cost index fund might charge, say, 0.2% a year, but the average actively managed fund, maybe 1.5%, some even over 2%.
Doesn't sound like that big a difference, 1.3 percentage points maybe?
Doesn't sound like it, but compounded over 30, 40 years, it's massive. On a typical portfolio, that difference could mean your net return drops from maybe 8.6% down to 7.3%. That gap adds up to hundreds of thousands of dollars less for you over time.
Wow. Okay, that's huge. It's real money, retirement money.
Exactly. And that's just the obvious expense ratio. There are hidden costs, too.
Like what?
Trading costs inside the fund. When managers are constantly buying and selling high turnover that racks up brokerage fees and other costs, Bogle estimated that could add another 0.5%, even a full percent or more, to your real costs.
Sneaky. And then taxes.
The black sheep, as he called them. Actively managed funds, because they trade so much, sometimes turning over 80% or more of their portfolio in a single year, tend to be really tax inefficient.
Meaning they spit out taxable capital gains to you, the investor, even if you haven't sold anything.
Precisely. You get hit with tax bills just for holding the fund. He had this great Vanguard index fund example. It beat 94% of its peers before taxes. Pretty good. Yeah.
But after taxes, it beat 97% of them. The low turnover made it incredibly tax-friendly.
So between the expenses and the taxes.
The expense and tax ogres, Bogle called them. He calculated they could potentially eat up over 3/4 of your potential long-term gains, leaving you with maybe only 23% of the projected capital after 40 years.
Okay, that's depressing, but also a powerful argument for controlling what you can control.
Which is primarily costs and taxes.
So if trying to pick winning stocks or winning managers is often a losing game, thanks to costs, taxes, and just plain unpredictability, what was Bogle's practical answer? The thing that really embodies buy, hold, chill.
Indexing. Plain and simple. Owning the entire market through a low-cost index fund.
Because active managers, on average, just don't consistently win.
Right. He pointed to their consistently counterproductive investment patterns, that crazy high turnover, 85% year on average, managers holding stocks for barely more than a year.
They're acting like speculators, not long-term owners. Exactly what Graham warned against. Exactly. And then there's that phenomenon, reversion to the mean.
Meaning today's winners are often tomorrow's losers. That whole idea that past performance doesn't guarantee future results.
Precisely. Bogle hammered this home. He used the example of the Legg Mason Value Trust Fund. Incredible run, beat the S&P 500 for 15 years straight, 1991 to 2005. A superstar fund.
Everyone must have wanted in.
Absolutely. But then, from 2006 to 2008, it lagged the index by a stunning 43 percentage points. Fell right back to earth.
Ouch. So chasing those hot funds or managers is usually a mistake.
A costly one. Bogle specifically warned against relying on things like Morningstar's star ratings. He said they have little predictive value for the future. Trying to trade based on stars, it usually leads to below-market returns at above-market risk.
Okay, so the alternative is the index fund. How does that perfectly capture the buy, hold, chill idea?
Well, first, it's the ultimate in simplicity. An index fund, like one tracking the S&P 500, doesn't need active management. It just buys and holds all the stocks in the index automatically.
This means super low costs.
Rock bottom costs, like 0.10%, 0.15% for classic index funds. Compare that to, say, 1.7% for an average international active fund. Huge difference right off the bat.
And that low turnover also helps with
Taxes.
Yeah,
Tax efficient. And risk, too. Owning the whole market is inherently less risky than relying on a concentrated portfolio or a single manager's picks. Broad indexes have substantially lower risks.
Okay, simple, low cost, tax efficient, lower risk. But do they perform?
That's the kicker. Yes. Over 15 years, Bogle showed the total stock market index beat the average diversified active fund by about 2.5 percentage points per year. The index fund captured like 99% of the market's return, while the average active fund manager gave up a big chunk to costs and friction.
The numbers just make the case, don't they?
They really do. It's why you hear guys like Peter Lynch, a famous stock picker, saying most investors would be better off in an index fund.
Or Charles Schwab saying only about 1 in 4 active funds actually beats the market, which is why he believes in indexing.
Yeah. What they initially mocked as Bogle's folly, this idea of just matching the market, is now totally mainstream. It's here to stay.
It's the triumph of experience over hope, as Bogle put it.
Beautifully said. Hope that you can pick the winner, hope you can time the market. Experience shows simplicity usually wins.
Okay, so let's bring this all together for you, the listener. We've walked through the wisdom of Graham and Bogle, two giants, different times, but they really landed on the same core truth about investing successfully.
Yeah, that the real way to buy, hold, chill, to find that stability and confidence, it starts with thinking like an owner, not a gambler.
Treating stocks like pieces of businesses. And then, embracing the market's mood swings Mr. Market's craziness, seeing them as potential opportunities, or maybe just ignoring them altogether.
Making time your absolute best friend. Letting compounding do its heavy lifting over decades.
While ruthlessly cutting down on costs and taxes, those ogres that eat away at your returns.
And finally, resisting that emotional urge to chase the latest hot trend or the star manager who probably won't stay a star.
It really is about mastering that internal game, isn't it? The psychological side.
It really is. Which leads us to a final thought for you to chew on. If you truly take on board Graham's point, that complex math often leads to more speculative conclusions in investing.
Bogle's common sense demand that funds should serve the owners, meaning you.
What does that actually mean for how you react to the next scary market headline? How you evaluate the next investment product someone tries to sell you? How you make every financial decision from this point forward?
Thinking about that shift in perspective, That could fundamentally change how you navigate the markets and maybe help you find your own sense of calm amidst the chaos.